We're going to start looking here at the 4 steps that they describe in calculating taxable income. So step 1 is to calculate what they term total income. Then we're going to calculate the adjusted gross income, or AGI. Third, we're going to subtract the greater of itemized deductions or the standard deduction. And then we may have an opportunity to subtract the qualified business income deduction. So let's start looking at step 1 here together. So step 1 is going to be total income. Calculate total income. It's going to include things such as salary, wages, fringe benefits, if they're taxable, net business income, which could be income from your sole proprietorship, or income from what they call a pass-through entity, so partnership or S corporation. It's also going to be investment income, so more of your passive income. That's going to be things such as your interest or dividends, capital gains, and rental property income. So notice the way income works, usually there's a rule that says all income is taxable unless you can have a specific reason why it's not. So, obviously the key is determining what really is included in taxable or not. This is the general formula of how we're going to go about working through the process. Step 2 then, as it mentioned, was calculating adjusted gross income. So this starts with that total income number, and then it's going to subtract off specific, what they call above the line deductions. So when you're looking at deductions, there's 2 types of deductions on the return, or at least 2. One is going to be above the line. So these are deductions that get adjusted from your total income before you come up with AGI, or above the adjusted gross income line. We're going to see later on, and that's when we're going to do that comparison between your standard deduction and your itemized deductions, how there's going to be a chance to have more deductions below the line. But above the line deductions are ones that get adjusted above this AGI. You're going to see most of the time it's better to have the adjustment above AGI. And we'll look at why that might be as we get on through calculating tax a little bit. But that's why they calculate. But there's only just a few things that get adjusted for above the line. And it mentions here, AGI is an important number because many deductions and credits are limited by reference to AGI. So many of the deductions and credits that you would calculate below the line of the AGI going to be limited or based off of a calculation that uses AGI. So usually the lower you get your AGI, the better, if you have a chance to make an adjustment. So that's step 2. Step 3, so as I mentioned, you subtract the greater of your allowable itemized deductions or your standard deduction. So each year you get a standard deduction amount depending on your filing status. And then you also add up what's allowable as, individual deductions that you've had. And then you're going to make a comparison. Either your itemized deductions, what you kept track of, adds up to more, or your standard deduction. The key is you get the greater of the two. You do not get both. You get the greater of the two. And you'll notice in just a moment, the standard deduction has been increased greatly. And so it's a lot more usual to see the standard deduction in current years than it was in years past. In fact, let's look at that. I think there's a slide here on standard deductions. So I mentioned it depends on your filing status. If you're married filing jointly, you have a standard deduction of $25,100. If you're married filing separately, you have a standard deduction of $12,550. If you're head of household, you get a standard deduction of $18,800. And if you're single, you get a standard deduction of $12,550. And that's one of those numbers I said changes each year just a little bit. These are 2021. So if you're working on your 2021 return, these are the numbers. However, if you're blind or age 65 or older, and you're married filing jointly or married filing separately, you get an additional $1,350. If you're blind or age 65 or older, and your head of household are single, you get an additional $1,700. Right, so you probably won't ask me already, well, why is there a difference between 1350 and 1700? I guess the most honest answer is your guess is as good as mine. I guess they think that if you're single or the only person in the head of household position, you should need a little bit more help, right? But in any scenario, I'd much rather not be blind than to get an additional amount of 1350 or 1700. So keep everything in perspective. And then there's this idea of being a dependent on another return, right? So all of this assumed that you were not being claimed as a dependent on somebody else's return. If you are being claimed as a dependent on another return, i.e. college students are a good example of this, your standard deduction is not that at all. It's either limited to the greater of $1,100 or your earned income, not all income, but just your earned income, plus $350. So there's a calculation or two we'll work through when we work through the problem, so you kind of see that why it's important. We just looked at earned income. It's not your investment income, in other words. Speaking of itemized deductions, right, there's a Schedule A. We're going to look at that more in Chapter 17, but it mentions here only a minority of taxpayers itemize deductions. Well, that's a true statement, I guess, currently, because the standard deductions went up so much a couple of years ago. If you're looking prior to that, that would not be the same answer. And when I read this and see minority, that makes me think less use it than actually do. So you still use it, see it used. And if you're preparing tax returns, it's better to keep up with everything, put everything in your system, and let the system decide. And that way you can explain to your client, hey, I appreciate you giving me all this information on your itemized deductions. We did put that in, however, your standard deduction was higher. There is this idea, we talk about tax planning some, about bunching. So if itemized deductions are close to standard deduction each year, taxpayers should bunch deductions in alternate years. Right? So what does that mean? It means you can, within reason, if you know you're not going to be able to itemize this year and it's December, maybe don't make that large charitable donation until the next year, till January, and then make it, because in that year you're going to be able to itemize because you'll have more. Well, some people did, and I don't know how much they were called on it or not, but they issued a warning on it. Some people, one of the things you'll see you can add to your itemized deduction total is property taxes. So some people tried to play the game of prepaying 2 or 3 years on their property taxes, or sending at least that much money in. And they got warning letters, or they sent out warnings to people saying, you really were not billed on this. So it's not like you were paying a tax, you were making a deposit on your account. So I'm sure that will be debated in some future tax cases, and maybe currently in some tax cases, where they got too creative in paying ahead on some of their property taxes. Right, but in general, that's what they're saying. Sometimes you can make some timing decisions, but you have to be careful in how you do that. Looking here at above the line deduction. So above the line deduction always reduces taxable income, right? So that's one of the reasons we mentioned I mentioned it's better to have above the line deductions, right? Because above the line, it's automatically low on your AGI. So just kind of think it through. I thought we had a number there, but just think it through where that's automatic. Your tax is going to be based off of a lower number. So it above the line, it does lower your taxable income. However, itemized deductions may, if your itemized deductions are more than your standard deduction amount, but if your itemized deductions are lower than your standard deduction amount, right, then that means they're not going to have the same effect. So a below the line deduction, that's why they say that it's not always guaranteed to lower your tax, and it's because you may just be using your standard deduction. You may not be relying on that. So that means classification as either above the line or itemized deduction often reflects tax policy and can change from year to year, right? And especially some amounts that we'll see as we keep looking through some of the the information that they allow you for above the line. Okay, so then in step 4, it says subtract the qualified business income deductions for qualified business income. So obviously not everybody's going to be able to take this. But if you had qualified business income, 20% is going to be given to you as a credit, or I should say as a deduction. So in broad terms, your QBI is income earned through a sole proprietorship, partnership, or S corporation less certain deductions, including deduction for self-employment tax. So at this point, really what I want you to take from me is why is this in here? It came about when the corporate tax rate got lowered. So if you filed a C corporation tax return after that change, you're now paying at 21% tax rate. That's a lot lower than what it was. Well, if you are filing a pass-through, so the way pass-throughs work, you get the statement with your share of the income. You report that income on your individual return, and you pay at your individual rates. So those individual rates now all of a sudden a lot higher than if you had just had a C corporation and paid, at that entity level. And that's what this is trying to do, is give you some of that money back, at least partially back of what you would have had to have paid, or what you could have saved if you were a C corporation but didn't because you were a pass-through entity and you pay at your individual rates. Is it all the direct offset? No, it's not a total offset, but that's what they're attempting to do there. So the summary thing here of the 4-step procedure, right? We have total income. We said we first adjust for above the line deductions. That's going to give us our adjusted gross income, or AGI. Then from that, we're going to reduce it by our itemized deductions or the standard deduction, the greater of the two. Then if we do have a QBI deduction, we're going to use that, and the result is going to be our taxable income. Last here, they give us a couple of examples of what they call tax computations, but it's not really working us through the whole 4 steps. It's just letting us see here that the status does make a difference. So we're not flipped back to it, but in your book, you're going to come to a section where you have formulas for each of the filing status, and in each of the filing status, depending on how much income you have. So there's going to be like ranges, and they say if you're between this range and this amount, then this is what you want to use for the formula, right? And same thing. So you notice they're different for each one. If you had, let's just assume $100,000 taxable income, and you say, well, would that make a difference? Right, yes, if you're married filing jointly, you'll use that formula, and the way the formula works, it says basically up to a certain amount, you start with $9,328. Then you add to that 22%, and that's again just based off of what's in that formula in the book, multiplied by the difference between where you're at and the base amount. So the amount of money you're over the start of that range, multiplied by 22%, added to $9,328, which really is, if you work through it, what it would be if you calculated the tax all through the lower tax brackets. That's what that would equal. And 22% times the amount you're into the current bracket, that means married filing jointly is going to have $13,497 of taxes. If you're single, you're going to use a different section. And you notice you're gonna just up until the start of that bracket, you've already owed more money, $14,751, and then you notice you're in the 24% tax bracket, so you're not in the same tax bracket. And again, $100,000 is your taxable income. That bracket that you're in for the single starts at $86,375. So the amount that you're over that entry point times 24% added to $14,751, which again comes from that formula, means you have tax due of $18,021. So just by being different statuses, you're either married filing jointly and have $13,497, or you're single and have $18,021. And they just show you that kind of a good little comparison. So it does matter. Filing status is important to get correct.